The past week has certainly been tumultuous for global markets, with basically all market participants consumed by what's been happening in the UK. Obviously, last Thursday night, the UK citizens voted 52% in favour of leaving the European Union, and subsequent to that, we've had quite a significant amount of political and also financial turmoil, and a lot of sort of back and forward, I suppose, as to what's next for the UK and also indeed for the global economy. It's worth mentioning, I guess, a couple of sort of key sort of facts. One is which at the moment we don't necessarily have a clear timeline in terms of when Article 50 will actually be invoked by the UK, which is what they need to do to actually, I guess, formalise their exit from the EU, and that would only then start a sort of a 2-year process of negotiations for new agreements with Europe before they actually formally left the Union. In terms of sort of how long we're likely to have to wait until we actually get a clear sense. It's likely going to be September or October before we actually have a new Conservative leader, and potentially also on the Labor side as well. We have this week found out that there's going to be sort of 2 key contenders with regards to the Conservative leadership. That's Michael Gove and also Theresa May. Both have emphasised overnight that they are very much looking to continue, I guess, or hold up the result of the referendum, and would actually continue to pursue a Brexit if they were elected as the leader of the Conservatives and indeed new Prime Minister. So that does set sort of the scene for what is expected to happen, but as I mentioned, it is going to be sort of September or October before they actually do come into power, and after that then there's potentially going to need to be further sort of actions in Parliament to, I guess, cement the ability of the Prime Minister to actually invoke Article 50 and the start negotiation period. In terms of sort of what sort of all this kind of uncertainty has meant for markets, we have seen equity markets fall sharply on the result, but then rallied back since then, such that the FTSE 100 is actually above where it was before the vote. The FTSE 250, which is a broader index for the UK, European shares and also global shares, are a bit lower than where they were ahead of the vote, but still that sort of risk-off sentiment that was immediately following the vote has well and truly reversed it over the last couple of days. In contrast to that, what we've seen with sort of global bond yields is a continued move lower. That's obviously on risk sentiment, sort of that debt markets have remained much more coy, I suppose, as to being sort of where on their sort of assessments of where the global economy is going, and also on expectations that we'll see further easing. So last night the Bank of England Governor Mark Carney spoke. He emphasised that the outlook had deteriorated following the Brexit vote, and there would likely be a need for the Bank of England to actually provide further accommodation. So we'll have to wait and see in July and August as to whether that means that they're going to cut the bank rate, which currently stands at 0.5%, or if they'll shift straight to alternative easing measures. For now, they've just emphasised they're willing to provide liquidity as it's needed, be it both short-term and also long-term through repo operations. So they're trying to bolster sentiment as much as they can, but fully expecting that both investment and also consumption will likely be considerably weaker than it would have been otherwise the case. Across in Europe, there's no real belief that the ECB will look to actually act anytime soon, but they are very much watchful of sort of the potential implications across the continent in terms of weaker confidence, and obviously sort of an unwillingness to actually look to invest, which has already been the case. So that would more firmly entrench that sort of weakness we have seen in investment. So that's likely to see, I guess, the ECB on hold until sort of at least early next year, which is kind of what we expected beforehand. They obviously only really got one sort of other method of easing at the moment, which is alternative easing measures. So that's likely to be sort of expanded come next year when the sort of the weakness and the impact of the confidence is coming through. We'll shift across to the US. There's hasn't been any sort of new data, but we have seen quite a significant fluctuation in terms of market expectations for the Fed. Immediately after the decision, we actually got to a point where there was a 20% chance of a rate cut by the Fed priced in by November this year. That has since reversed, but there is now no longer sort of a rate hike priced in until the end of 2018. So prior to the whole Brexit situation, that was sort of the end of 2017 or mid-2017. So that is, I guess, an emphasis that the market's sort of wondering whether there's likely to actually be another rate hike, or whether we might just be on hold for the foreseeable future in the US. We continue to believe that this is not the end of the rate hike cycle, but there really needs to be a clear path forward for the US central bank if they are to hike rates, and that's going to really depend on the reaction of the consumer and also of investment in the US, and that's going to be their focus going forward. That's actually quite a nice segue into next week. The focus there is actually going to be, at the end of the week, is going to be on payroll. So for the US, we after two quite weak outcomes. We're likely to see a bounce back to probably about 190,000 jobs added in the month, and that would help, I guess, allay fears of both of the consumers across the US economy as well as the Fed, that they're not necessarily having to worry about particularly significant downside risk to their domestic economy, and they can just focus on balancing the sort of momentum that they are seeing in the domestic economy against the global risks. And closer to home, next week we also get the RBA meeting. So this will be the first time we'll get to see their expectations around Brexit. They have mentioned in the past as being a sort of a risk in the future. Now that the vote has happened and we have got the result we've got, obviously they'll likely emphasise the risks and also we'd probably argue considerations around the currency. So whereas the pound has actually sort of stayed near its lows, the Australian dollar has rallied back and it's now sort of sitting quite similar to levels to where it was pre-vote, sort of around that sort of 75 cent mark against the US dollar. So there's not really a lot of change relative to when they cut rates in May as to sort of the impact on the Australian dollar, and they'll be sort of, I guess, watchful as to how that plays through and how that balances against the global risks and also commodity prices as well. So that'll be sort of the key areas they're looking at. We don't believe they're likely to cut rates next week. We're still looking towards August. That would allow them to assess inflation as well before making the next decision. And from there, it's potentially the case that if we continue to see sort of market fragility globally and it's sort of an uncertainty as to the impact on the real economy of what's been happening in the UK, then the RBA might look to continue to have, I guess, an easing bias of some sort, whether it's kind of a passive or an active one, really emphasising that they're willing to do more if it's needed, but at the same time believing that the economy is currently sort of doing okay with growth running about trend and the unemployment rate remaining relatively modest, sort of, and well below 6%. So at the moment, it's on hold in July, a cut in August, and then sort of a loose easing bias from there as to just to try and support confidence. So we'll come back next week and wrap that up for you.